The US national debt is growing faster than ever. What happens next? The United States has the largest economy in the world, but it also carries one of the largest national debts in history. Every year, the debt grows. Every month, the interest bill grows. And every day, the government borrows even more money. The biggest question is not how much debt exists. The real question is, can America continue living with it? Most people hear the words national debt, but very few understand what it actually means. National debt is not the money you owe, it is the money the US government owes. To investors, to pension funds, to foreign governments, and even to its own agencies. The government borrows money by selling Treasury bonds. Investors buy those bonds. The government receives cash and promises to pay it back with interest. This system has worked for decades because investors believe the United States will always repay its debt. That trust is the foundation of the entire system. But today, the numbers are becoming much larger. The debt continues rising, not because of one crisis, but because of years of spending, economic stimulus, military budgets, healthcare programs, infrastructure investment, and interest payments on existing debt. Now another challenge has appeared: interest rates. For many years, borrowing money was cheap. Today, interest rates are much higher. That means every new dollar borrowed costs more, and every old bond that matures must be replaced with a more expensive one. As a result, interest payments continue increasing. The government spends hundreds of billions of dollars every year just paying interest, not building roads, not funding schools, not expanding infrastructure, only paying interest. This changes everything, because money used to pay interest cannot be spent elsewhere. That creates pressure for future budgets. Some people ask, can America simply print money? Technically, the Federal Reserve can increase the money supply, but creating too much money can weaken purchasing power. It can increase inflation and reduce confidence in the currency. That is why printing money is not a permanent solution. Another important question: who owns America's debt? A large portion is owned inside the United States. Banks, mutual funds, insurance companies, retirement funds, and millions of American investors. Foreign governments also own Treasury securities. Countries such as Japan and China have historically been major holders, but ownership changes over time. The important point is this: the United States depends on investors continuing to buy Treasury bonds. As long as demand remains strong, the system continues working. Now consider economic growth. If GDP grows steadily, tax revenue usually increases. Higher tax revenue makes debt easier to manage. But if growth slows, debt becomes heavier. This is why GDP matters, not just for headlines, but for the government's finances. Now think about demographies. America's population is getting older. That means more spending on retirement benefits, more spending on healthcare, and greater pressure on public finances. These obligations will continue for many years. The government must balance economic growth, tax revenue, public spending, and borrowing. None of these decisions are simple. Now look at financial markets. When investors believe America remains financially strong, Treasury bonds remain attractive, the dollar stays strong, confidence remains high. But confidence cannot be taken for granted. It must be maintained. Markets watch budget deficits, inflation, interest rates, employment, and economic growth, because all of them influence confidence. Confidence influences borrowing costs, and borrowing costs influence the national debt. Everything is connected. Some people believe high national debt automatically causes a crisis. History shows it is not that simple. Countries have managed large debts before. The real issue is whether debt grows faster than the GDP. If economic growth keeps pace, debt becomes easier to manage. If debt grows much faster than GDP, pressure increases. This is the challenge facing policymakers. Now consider the Federal Reserve. Its responsibility is not reducing government debt. Its primary goals are stable prices and maximum employment. But its decisions indirectly affect borrowing costs. Higher interest rates fight inflation. Lower interest rates support growth. Finding the right balance is never easy. Now ask yourself, what happens next? There are several possibilities. Economic growth could remain steady, debt could continue rising but stay manageable, or unexpected shocks could slow growth, reduce tax revenue, and increase borrowing needs. No one knows exactly which path the economy will follow, but one fact is clear: national debt will remain one of the biggest economic challenges of the coming decade. Not because collapse is guaranteed, but because decisions made today will shape America's financial future. The US economy remains innovative, its businesses continue creating value, its financial markets remain among the world's largest, its currency remains the global reserve currency. These strengths still matter, but strength does not eliminate risk, it only provides more flexibility. The future will depend on responsible policy, sustainable growth, and maintaining investor confidence. Because in the end, debt is not only about numbers, it is about trust. And in economics, trust is the most valuable asset a nation can have.